Hi guys, welcome back. We're continuing on with our objectives of financial management, and today we will move on to efficiency. Remembering the last lesson we've been looking at growth, so businesses are looking to achieve growth in the context of market share, profitability, might be the number of items that it sells, and before that we looked at profitability, the difference between total revenue and total cost. So efficiency, what actually is efficiency from a financial sense? What I want you to do now is think about a business that you think is efficient. Okay, we haven't gone into any detail about what efficiency actually is. Think back to maybe year 11 business studies, year 10 commerce, and think about a business which you think is efficient. We'll touch on this in class next lesson. What's a business that you think is efficient and why? What makes that business in your eyes efficient? And then on the contrast, we'll think of a business that you think is inefficient. What is it about that business that makes you think it is inefficient? We'll have a talk about that in class next lesson, but just have a think about that between now and next class. So if Consure was considered to be an efficient business, how would you measure that? Something else we'll have a look at in class. Okay, so moving on to a bit of an explanation about efficiency. Efficiency effectively is how much output are we getting for a given level of input. So that input, if it's a manufacturing type business or a production type business, how many iPhones are we producing per hour? How efficient are we? How many iPads are we making per month, per year? And how efficient are we? And how many workers are we needing to use to achieve that level of output? If it's Qantas, how many people can we get onto a plane? How many planes can we fly per day between Sydney and Melbourne? How many flights can we fly between Sydney and Brisbane per day, per week, per month? Okay, how efficient are we? How many staff do we need on each plane? How many people do we need on the ground? Engineers, baggage handlers, etc. How efficient are we? And is that allowing us to achieve our objectives of financial management? Those objectives might be profit or whatever those objectives are. And bring it all back to the role of the financial manager, which is what this chunk is all about. It's the financial manager's job really at the end of the day to try to reduce costs and maximize the output. So they're the ones who are trying to manage all of this process. We want to reduce our costs. So if we go back to Qantas, we don't want to have too many people, too many baggage handlers if we don't need them. Bearing in mind, we also want to be running an efficient organisation. So we want to have enough people on the ground. We don't want to have too many engineers. We don't want to have people getting in each other's way, which is costing us money. And we want to maximise our output. So we want to have enough staff that we can get all passengers onto the plane in a short period of time. We can serve all those people on the plane between a flight from Sydney to Melbourne, for example, that we can try to, that we can effectively manage them. So efficiency, again, like profitability was, it really is a balancing act. Profitability is balancing between total revenue and total cost. Efficiency is balancing being really efficient and bordering on being inefficient and making sure that the business is walking that tightrope effectively. Bit of extra information, I guess, about efficiency, because that's really efficiency at its most basic level. But it's about a business trying to use its resources effectively. Its resources might be people. Its resources might be planes. Its resources might be the items that make up an iPhone. And the financial manager is trying to achieve as much output from the same level of input. And it's about managing those inputs effectively to achieve as much output as possible. Okay, I'll just let you read that last point there about financial planning in your own time. So moving on to liquidity, if that's efficiency, if efficient is about getting the most output from a minimum amount of input, what's liquidity all about? For those of you who did year 10 commerce, you touched on liquidity. You would have touched on it last year in business studies. What is liquidity? We'll have a look at this article on Qantas in class tomorrow about their issues with their liquidity. Okay, but liquidity, at the end of the day, liquidity is really about cash flow. Okay, so how easy can your assets, generally cash, stock, accounts receivable, they're your current assets, cash, stock, accounts receivable, they're your three main current assets. How easily can they be converted into cash to finance your current liabilities? Okay, your accounts payable, for example, how easy, and is the business able to do that effectively and efficiently? So it's really about meeting its short-term objectives. Does the business have enough current assets, cash, stock, accounts receivable, that can be converted into cash, which will allow it to meet its current liabilities? Like I said, they are generally a bank overdraft and your accounts payable. Does it have enough? If it doesn't, the business is facing illiquidity. Okay, this is really just touching, these points are just touching on what I've already mentioned. And it's about the financial manager making sure that that business is in a situation where it can pay those short-term liabilities. Generally, like I said before, accounts payable and a bank overdraft, that being a short-term loan. Again, I'll let you read the last point in your own time about effective financial management. This is something mentioned in your textbook. I'll let you cover that in your own time about 3 different types of uses for cash. Okay, and I'll do another video on solvency, so I'll stop it there.